Good morning, everyone. This is Stuart. Hope you had a great weekend. On this week's update, we'll cover the Moody's downgrade of U.S. credit and also some recent concerns about Apple. Moody's downgraded U.S. credit on Friday, stripping us of our AAA credit rating. It noted concerns about rising government debt and a widening budget deficit. Now, if you've been following the U.S. fiscal picture anytime in the last few years, this probably won't come as a surprise. Our annual deficits have been in excess of 5% for some years now, and our debt to GDP ratios have climbed to 120% and rising. This, at least in the near term, is having a slight effect on treasury yields. The 30-year treasury is above 5% this morning. The 10-year treasury is back above 4.5%. We think that longer term, there's little risk that comes from this downgrade. The U.S. is not going to default on its debt payments. The bigger risk is any slight shift in the narrative about our credit situation and bond investors getting a bit skittish and treasury yields rising from here, which could weigh on stock prices. The bigger story in our view is the latest from Apple. Over the weekend, Bloomberg had a very deep expose on the company's struggles in artificial intelligence. We think that's worth reading, and that story comes on the heels of some other stories that hit on the services revenue narrative and its risk from a few antitrust cases. One of those stories about how the Google annual payments of about 20 to 25 billion to be the default search engine on Safari might be at risk, and also whether the 30% App Store fee that Apple charges to developers is also at risk. Apple's stock has greatly benefited from this services revenue narrative. If you recall, about 10 years ago in the 2010s, the stock traded at a mid-teens multiple when the narrative on the company was that it's a products company. And as soon as investors started to appreciate the growth from services, the valuation started to rise, and the stock currently trades at about 29 times forward earnings. Here we have a breakdown between products and services revenue for the company. Products revenue, which is iPhone, iPad, and the Mac, also AirPods, has flatlined the last 5 years at about 300 billion, whereas services revenue, which includes the App Store fees, the Google payments to be the default search engine on Safari, and also subscriptions for products like Apple Music and storage, have more than tripled since 2017, and today are about $117 billion. Now, investors really like that services revenue because it's viewed as recurrent, whereas the products revenue is viewed as a bit more cyclical. So again, the stock really has benefited from that change in investor perception. If investor perception starts to change again, and there's questions about the longer-term viability of any of that services revenue, or its competitive position in artificial intelligence, the risk is that investors no longer are willing to pay 30 times earnings for the stock. Here we have a sensitivity matrix showing Apple's fiscal year 2026 EPS expectations, which currently are $7.82 per share, versus the forward multiple on that earnings, which currently is at 27 times per share. And you can see how the stock price would react to any changes in the variables. The risk for Apple is that investors decide that a premium multiple to the S&P is no longer warranted, and if it falls to just the market multiple of 22, we could be looking at a 19% downside from the current level, even if earnings per share holds up. Now, we don't think the business is at risk at plummeting. We don't think the stock is at risk at plummeting. But we do think that some of these challenges around artificial intelligence and additional antitrust scrutiny could potentially weigh on stock price performance in the near term. On the AI side, the company does have several levers it could pull, whether that's a combination of management changes, new personnel hires, or a different approach to AI, such as doubling down on building its own model, or even incorporating ChatGPT or Google's Gemini into iOS. We think that over time, these challenges are surmountable, but again, near term, this is going to potentially weigh on investors' minds, and it could be a headwind to stock performance. So if you want to talk to us about your Apple position, please feel free to reach out. Happy to go into all of this in a lot more depth. If you have any other questions about your portfolio or the markets generally, feel free to reach out. Thank you very much and have a fantastic week.